Gautam Duggad is joining us now, Head of Research at Motilal Oswal Institutional Equities, and we're talking to him about what Q2 is looking like. Gautam, hi, great to have you on. Let's start.
Good morning.
Good morning. Let's start with the numbers that we have seen. Of course, we'll review sector-wise, but let's start with the. Are you disappointed with the way things have started off with TCS?
Not really, Tamara. Yes, it's a bit of a dampener on margins, but I think there can be some segment-specific reasons for it. On the contrary, we are very excited with IT. We have doubled down our weight. We used to have underweight till April, and July made it overweight, and now in this quarter's revision of model portfolio, we have further increased our weight in IT. However, we don't have TCS in the model portfolio. We have Infosys, HCL Tech, Persistent, and Coforge. But yeah, I mean, we are significantly overweight on IT now. In an overheated market, we think IT provides a lot of stability top down. At the same time, from a bottom-up basis, the narrative around IT will improve in next 3 to 6 months. That's our view. And relative valuations in the context of the market are still quite reasonable, given the kind of balance sheet cash flow characteristic this companies have over the years demonstrated in terms of almost, on a combined basis, if you look at last 6-7 years, cumulatively they've returned 80% of total, profits to shareholders through buybacks or dividends.
Okay, so Gautam, good morning. What's the Neeraj here? What's the base case assumption for Q2 on IT? Are you even thinking of Q2 results, or are you more focused on what they say about what will happen in Q3 and maybe Q4, because by then the US election overhang will be truly out of the way?
Sure, Neeraj. So when we upgraded IT to overweight back in July, we just upgraded it basis our construct on valuations. The risk reward then looked very attractive. We've had underweight on IT for more than a year. In fact, almost 2 years. We thought situation is now reaching a stage from where risk is less and reward is more. Especially in large cap, because midcap anyways has been doing well, given the good growth differential which has lasted for such a substantially long period of time. I mean, Neeraj, if you look at last 20 years relative valuation chart of midcap versus large cap IT, you will find that in the past, every 2 years, midcap IT used to slip into discount and then go into premium. In this cycle, for last 4 years, the premium of midcap IT versus large cap IT is sustained. And I think one of the reasons is the big growth differential that midcap IT is demonstrating. So our view changed particularly on large cap IT in July, which is where we thought in a market where every segment, every sector is looking a richly valued X of financials, IT offers a reasonable risk reward construct. We didn't expect any significant improvement in operational performance immediately. So to that extent, you are right. I think the numbers and the rest of the operational commentary should start looking better as you move into December and March. But our call was predominantly led by relative valuation construct on IT.
Okay. So Gautam, the other question is really, and just rounding off this question on IT, the commentary that we hear is that we know that ER&D will perform well, but it's expensive. Large cap IT will have a sluggish Q2. Maybe the commentary ahead might be constructive mildly, that things are picking up, but no definitive moves there. And thus far from TCS and LXC, we've kind of heard the same. The commentary is very good from LXC. The commentary is reasonably okay for TCS. Where do you park your money? I mean, what is the first amongst equals? Is it mid-cap IT? Is it large cap IT? Or is it ER&D?
No, of course, see, Neeraj, IT sector is still predominantly large cap heavy. If you split the market cap of IT sector and profitability, roughly 90% of the profits come from top 5 or top 6 IT companies, which are basically nifty IT companies. All the other IT companies put together, mid cap, small cap, everything, contribute just 10% of the total profit pool, but they're growing very fast. So for example, I agree that mid cap IT is expensive, but they were expensive at 1/3 the prices too. You go back a year and a half, look at how Persistent was valued then. Nobody then said that Persistent is cheap, right? Persistent is up almost, I think, 20x in the last 5-6 years. You can make the same argument for Coforge. You can make the same argument for KPIT for that matter. Look at the numbers of KPIT. In 3 years, the profits are of 4x. And our view is that some of these ER&D niche plays, which are a play on very specific category or domain, they can continue to demonstrate stronger growth differential versus large cap IT. So you have to have a blend of both mid cap and large cap, so that you're not putting all your eggs in one basket, because large cap IT also offers very strong balance sheet and free cash flow characteristics, which you perhaps do not get in mid cap IT. But mid cap IT compensates that by providing you higher growth. Even this quarter, as per our own estimates, we are expecting Persistent to put 4 to 4.5% constant currency quarter-on-quarter revenue growth. So you have to have a blend of both, so that you're not going overboard on either side.
Gautam, let's just go sector-wise, and I want to understand how you're looking at all the the auto companies, because big hopes on festive season are coming in, but are you expecting a little bit of a disappointment this quarter?
Yes, in fact, see, Taman, let me go back 2 years. We had a big overweight stance on auto for almost 2 years, which we changed to underweight in July, and we are continuing with that underweight stance. In fact, this year we are expecting moderation in auto earnings growth, and this particular quarter we are just expecting 7% earnings growth, which will be the lowest in last 12, 13 quarters. Do remember that auto earnings have tripled between FY21 to FY24. If my numbers are correct, in FY21, the auto profits in Nifty were 18,000 crores. In FY24, they were 62,000 crores. This year, we're expecting 7% growth. And in anticipation of that, we have downgraded auto from overweight to underweight. Our construct was very simple, that we have a very high base on both volumes and margins, right? And which is what is playing out now. Within that overall underweight stance, we have two names in our model portfolio. We've been very positive on M&M for last 3 years. In fact, we might be one of the few houses which has no Maruti in model portfolio. We only have M&M. And now we've added TVS Motors too, right? So we've tried to keep one four-wheeler, one two-wheeler. Insofar as two-wheeler is concerned, relatively they are better off right now in terms of monthly volume progression. If you look at TVS itself, is one of the few companies in auto universe, or for that matter, the entire coverage universe of ours, which has printed 20% plus earnings growth for last 12 out of 12 quarters. So they've been very consistent. Their monthly volumes have been pretty fine. I agree. That stock is also richly valued, but which is not richly valued today. Any stock which is demonstrating good growth in India is hardly coming at a reasonable valuation. But if this growth continues and this margin performance remains stable, I think there is still more upside to be had, and which is why we've added TVS. But overall view on auto remains underweight for now. We're expecting FY25 to be a very low growth year for auto.
Gautam, hi, it's also Samina joining in. While I'll of course talk to you about the umbrella and the earnings as whole, but from what we understand from your report, you believe that most companies, while expected to show moderate earnings, you've identified 6 companies that are likely to report a 35% surge in net profit. I think SBI Life, Apollo Hospitals, Trent, Bharti Airtel make up that list. You want to quickly tell our viewers, where does your optimism sit?
Yeah, so Trent has been a favorite idea for us for a long time now. In fact, if I remember last row, we extensively discussed Trent, Zomato, and Varun Beverages with Neeraj. So any company in India which is demonstrating growth differential in the sector, the market has been very, very charitable with the kind of valuation it has been ascribing to those companies. For example, if you look at Trent itself, they're growing top line at 50 to 60% for last many quarters now, whereas the sector is struggling to grow at 15-20%. Of course, profits have doubled or tripled, and therefore at every price, the stock looked expensive at 2,000, at 4,000 about 10 months back, and now I think 8,000. So as long as growth continues at this pace, I think valuations are going to remain very, very demanding there. But yeah, this quarter also we are expecting very strong performance from Trent, and we expect that to get better again in the festive season. Insofar as Bharti is concerned, Samina, I think telecom sector is going through a very different level of consolidation right now, whereas Bharti has demonstrated that in the last 4-5 years that despite high competitive headwinds and a lot of flux in the sector as far as regulatory cholesterol is concerned, they've been able to manage their market standing very well. Now we are reaching a stage where ARPUs are also going up, and consequent to that, you're also seeing some bit of softening in capex intensity. So both put together essentially means that your balance sheet and free cash flow characteristics for Bharti will also improve. We think that Bharti can continue to grow well from here as well. But do remember, last 3 years, they've had a phenomenal run as far as stock is concerned. Market cap is somewhere close to, I think, 9 lakh crore now. On that base, of course, you cannot expect stock to double like it has doubled in the last 2 years. But still, given the kind of market share, ARPU, and fading off of capex intensity is there, I think this stock can remain a big part of allocable portfolio. I think for insurers, you don't have to look at PAT. You can perhaps look at VNB, where both SBI Life, HDFC Life are demonstrating good numbers. We had upgraded HDFC Life recently, and now we have added HDFC Life in our model portfolio too.
Right. Just one quick one on cement, and I'm talking about cement because the stocks have also been under tremendous pressure. And it seems, Gautam, that they are going to report a 41% decline year on year. I mean, this is concerning, I would imagine.
No, but Samina, this is how cement always behaves. Last quarter was also bad. This quarter is also expected to be very weak, and we are expecting next quarter, which is December, to also have a 30% earnings decline. The concerning thing this time, however, is that our volumes are flat on a YOY basis. This flattening of volumes is happening after a very, very long time. I've not seen a 1% YOY volume growth in cement in the last 4 to 5 years in any quarter, maybe except COVID. So that is more concerning. Second, of course, the price increases that they've taken have not been, holding. So which is creating a double whammy on EBITDA margins. So if you look at EBITDA per ton for this quarter, we are, I think, expecting somewhere about 647 rupees, which is at a multi-quarter low. Now, the hope is that at some point of time in this year, around March, those numbers will improve. But at the moment, we have zero allocation to cement, and we're expecting a very weak quarter across the board for all cement companies.
You are not buying into the valuations of some of the cement names because a lot of those have been flatlining now for not just quarters but years as well. And with all these development projects that are announced in South, right, Amravati city, etc., specific pockets of cement, even that is not attractive enough.
No, so they would definitely be attractive at some point of time, Neeraj. However, we are in a market which is performing market. So you have to be very cognizant of your capital. You cannot have a dead capital sitting in your portfolio for a long period of time. I'm not saying we cannot make mistakes, but all I'm saying is the attempt is to try and find ideas where the growth is looking good, and we've been growth investors. So what we are trying to do is that whole theme that you said on infrastructure, we're trying to play it through multiple other names. Like real estate, we've been having a huge overweight, which we are continuing. We have a big overweight on industrials. Now we've also added Dixon in our model portfolio. We continue to have ABB. We've also increased weight on L&T, where the valuations have become far more attractive now. But cement with 30-40% kind of an earnings decline, which is visible right now, and even for the next quarter, I think you might get better price, or you might get better time to buy those stocks.
Okay. So, Gautam, here's therefore the question. If the earnings season shapes up exactly as your note has penciled it to be, you know what, and let's assume that the prices don't move too much from where they are currently. Where is the best bang for the buck? Where is the best value and growth proposition within the coverage universe?
So I think there are two segments, Neeraj. I hope that market remains, or rather consolidates for some more time, because we've had a phenomenal run in the last 12, 18 months. More so in mid and small caps. We're finding idea is becoming extremely difficult. And if growth slows down, which is what is happening, FY24, if you look at Nifty earnings was up 26%, our broader coverage universe reported 32% earnings growth. So that's why last year we were very positive on mid and small cap, because we could see growth sustaining in FY24. This year growth is moderating from 30 odd percent. This year we are expecting 7% for our broader coverage universe and 7% for Nifty as well. So it is very important for market to consolidate, spend some time in the zone, allow the earnings to catch up. Now, if that were to happen, and let's say we get Nifty at 25,000 again in January or March, then again valuations, at least for large cap, become slightly more attractive. Even today, large caps are quite fairly valued in my view. It's a mid cap and small caps where there's a lot of problems on valuation. Your mid cap index is trading at 35 PE, which is a 60% premium to Nifty PE. A small cap is usually if you look at a 10-year average, trades at a 24-25% discount to Nifty, is today trading at a 10% premium. So in this kind of a backdrop, what we've done, one of the big calls we have taken in our model portfolios, we have moved private banks from underweight to overweight, right? So we've increased weight in ICICI, HDFC Bank. We've also introduced Kotak Bank in our model portfolio. We've added HDFC Life. We've added some of the niche alpha plays in NBFC like Five Star Business. We've increased weightage on Angel. So overall financials have gone to a chunky overweight for us, right? And all three segments of financials are overweight: private bank, PSU bank, diversified financials, NBFC. So that is one thing we've done. IT is already a big overweight. So both top down and bottom up, you can say, or rather you can conclude that our portfolio today is slightly more defensive than what it has been. We are, of course, still overweight on industrials, healthcare, but we've gone underweight on auto. And consumption also, we've gone from overweight to neutral now. Some of the high flyers and discretionary names like DMart, Kalyan, we've taken out. We have instead doubled down our allocation on names like Metro and Cello, which have not performed, and which, if the festive season is good and discretionary demand recovers a little bit, with that perspective, we've added further weights in both Metro and Cello. So staples, we are underweight. We still have only Hindustan Lever in staples. So that's how we are trying to juggle around in this kind of a market where valuations are very, very punishing in mid and small caps right now. So in fact, our bias is predominantly toward large cap now. If you look at our model portfolio, 75% of our weight resides in large cap now. Only 25% is mid and small caps.
From your report, we understand you've cut your Nifty EPS for FY25 and FY26, and you believe this is one of the worst quarters you've seen in the recent past. Let's keep this quarter behind us now. When do you think the rebound from the next quarter is a fair expectation for street participants to have, or do you think this quarter is going to be followed by very aggressive downgrades?
Actually, Samina, let me qualify that downgrade by just explaining the nuance behind it. So 4% on a headline basis looks very big downgrade, which it is, but you have to just layer it down and see which are the stocks which have driven those downgrades. So out of the 4% downgrade, 80% of that 4% has come from just four stocks, which is Reliance ONGC, Tata Steel, and JSW Steel. Rest 46 companies, there the earnings revision has been very flattish. If you look at the broader markets also for our coverage universe X of Nifty, there are about 225 stocks. There also the earnings revision has been flattish, maybe -1 to -1.2%. So while that 4% number looks a bit scary, if you see through the details and take a deep dive, it's not a very broad-based downgrade. And now we have seen a cycle of 2015 to 20, where every year we used to see across the board, across the sectors downgrade. So no, this is not that kind of a situation. And we do expect this to change, in FY26, where our expectations are still pretty healthy. We're looking at 17-18% growth. So in fact, Samina, if you see last 5 years of earnings trend, every alternate year we've got a slight moderation in the growth. So FY22 was a 40% earnings growth year for Nifty. FY23 was 10%. Then FY24 again we saw 26%. This year it is 7%. And then again, FY26 our expectation is about 15 to 18%. The thing is, when earnings changes, either on the upside or on the downside, are disproportionately led by commodities, the market tends to see through them. When you saw 40% earnings growth in FY22, market didn't get too excited in FY22 because X of commodities, the growth was still 21% only that year.
So Gautam, I'm just going to come to you. Important point you made, that 4% EPS cut is being contributed by four major companies. And let me come to the biggest of them, RIL. Let's get into a little bit of a detail by what you're expecting in Q2, and is there a bit of worry there? Where is it? Which vertical is it coming from?
So it's coming across the board actually, Tamanna. So standalone, we have seen that Singapore GRMs have been very flattish QOQ. So there has been change in estimates around that on a full year basis. We've also cut retail estimates by about 8 to 10%. And we've also marginally tinkered around with the geo estimates too, where we've cut by 3 to 4%. So net Reliance itself on an aggregated consolidated basis has seen about 8% of earnings downgrade, which is pretty big for a company of that size and that weight in the index.
Okay, thank you so much, Gautam, for speaking with us. I mean, it's always fun chatting with you, and we can go on and on, so much more to ask you, but we will see you back for the review of Q2.
Sure.
And we
Thank you so much for having me.
we look forward to hearing from you then. Gautam Duggad of Motilal Oswal on what Q2 is setting out to be and could be disappointing for some.